our Coin Ledger live stream. We know that the crypto tax deadline is little less than a month away, and obviously, I mean, we work with crypto taxes every day. We know how stressful it can be, especially in the weeks leading up to the deadline. So we wanted to just make sure that you had the answers to all of your questions. So we got three great guests with us here today. So first off, we got Jordan Bass. He runs his own crypto tax and crypto legal firms. If you've watched these live streams before, you know how knowledgeable he is. I'm glad to have him on again. Uh, Next off, we got our special guest for today, Andrew Gordon of Gordon Law Group. Like Jordan, he has his own crypto legal and crypto tax firms, and incredibly knowledgeable dude on both of these topics. Last but not least, we have our CEO here at CoinLedger, David Kemmerer. He's been building in this space for a long time, and super excited to hear his insights. So we're going to get started asking questions really soon. Feel free to drop your questions into the chat. Um, First off, a short disclaimer. Nothing you hear here today is financial, legal, or tax advice. Um, this is for general informational purposes only. Please reach out to your tax professional for specific questions pertaining to your specific situation. Well, hey, we got 30 minutes, so let's get started firing away. First thing I want to ask, something pretty relevant, I think, to most of the people listening. Um, what should investors who haven't filed their taxes yet be doing in the next few weeks? We'll start with Jordan. What do you think?
Yeah, so I think the reality of the situation is if you have a fairly complex, digital asset history, transaction history, and you haven't begun reconciling that activity, you should probably start now. Because if you don't, maybe you'll have to file an extension because you don't want to file a tax return without your crypto information. Now, filing an extension is not the end of the world, but the problem is if you haven't determined where you stand from a tax perspective with your digital asset activity, and in 2022 you made money like a very small majority of people, you may need to determine what your estimated tax liability is so you can pay, because an extension to file is not an extension to pay. So if you haven't started, I would say please begin doing so. If you think it's going to be a huge lift for you to be able to figure this stuff out, even using CoinLedger, it's still going to be a difficult task for you. I would start thinking about filing an extension, but understanding that if you had income, if you generated income from, your crypto activity, whether that's yield, whether that was staking rewards, whether it was capital gains, you have to be able to determine what that is so that you can make an estimated payment, an extension payment with that filing. If you're not sure how to even file your crypto taxes because this may be the first year that you had some material activity in crypto and you don't want to mess the return up, it's not an excuse. It's not a good excuse to not file any crypto activity, right? So again, file an extension if you need to. You could reach out to Andrew and his firm. You could reach out to us. You could reach out to the support team at CoinLedger. They could help you out. But you don't want to just not file. And that's the main thing I would say. Don't panic and don't not file anything, because those late filing penalties are substantial. They can be. That's what I would say. The high level, just focus on getting it done. And if you can't, it's not the end of the world if you do have to file an extension. But there are things that you need to consider when doing so, especially if you've never filed an extension before, which a lot of crypto investors, sometimes it's their first time going on extension, or their second or third, depending on how active they've been in the space.
Gotcha. Gotcha. Great answer. Andrew, anything you want to add on to that? What should investors be doing if they haven't, filed their taxes yet?
Yeah, I think Jordan did an excellent job of identifying a lot of the different options and what should be done. Certainly get started on your crypto if you haven't already. But I would also emphasize the point to file an extension perhaps even now, because we see year over year that people, as they get closer to the deadline, may even forget to file an extension or think that it's automatic. You can always file the extension and still file by April 15th. The penalties for failure to file are 10 times worse, literally 10 times worse than the penalty for failure to pay. So just by filing that extension gets you that 6 months without having that failure to file penalty. So just as a preventative course, it may make sense to just get one on file now.
Yeah, great tip. So David, any last thing you want to add on before we move on here?
No, I think that was good. I'd say, we'll welcome you with open arms to CoinLedger if, you need to still get it done. So coinledger.io.
Yes, link is in the description. But just one last question I do want to ask you guys before we move on to the audience questions. So obviously 2022 was a huge down year for many investors, and it's probably more likely that if you were an investor in 2022, you took losses rather than gains. So a lot of people aren't aware of the tax benefits of realizing losses. So do you want to talk a little bit about these benefits? We'll start with Andrew this time.
Yeah, sure. So to begin, you still need to report your crypto transactions on your tax return, even if you have a loss, even if you broke even if you're not sure, you still need to figure it out and you still need to report it on your tax return. But it's not all bad. In fact, by reporting losses, it can be a strong tax advantage to you, either in the current year or in the future. So crypto capital losses, meaning that you've sold crypto for a price that was lower than when you purchased it, generates a capital loss. And that capital loss can be used to offset crypto gains from other trades in the current year, but it can also be used to offset gains from other trades from property, things like stocks or even real estate. So having those crypto losses, although we look back at 2022 and a lot of people are very upset with how things have occurred, from a tax standpoint can be beneficial. Those losses can be used in the current year against capital gains. But if there are no capital gains to offset, which, hey, 2022 certainly has happened, then up to $3,000 of those capital losses can be used to reduce your ordinary income from things like a W-2 job. So $3,000 a year, not a whole lot, but hey, every dollar counts. And then you might be thinking, well, what happens to the remainder? I've got massive losses last year. $3,000 is barely a dent. The good news is it can be carried forward, at least under current law, carried forward indefinitely. So those losses next year, if you have gains, can offset the gains then. And if there are no gains, then it can still offset income, $3,000, and on we go. And so often a good tax strategy is to harvest or realize losses, especially under current code, because those losses can be used in the future, but they can't be carried backwards. And what we see sometimes is clients incur gains. Shockingly, we've seen clients that had gains in 2022 because they had very limited trades, but executed those trades purposefully to have gains. From an investment standpoint, awesome. From a tax standpoint, not so great. And you can realize those losses in the current year to have reduced those. But now in 2023, it's too late. You can't carry losses back to 2022. You can't carry them back to 2021, but you can carry them forward. So in a lot of situations, it makes sense to realize those losses. There are other things to consider. So not in every case, but by realizing those losses, you can use them in a variety of ways now and in the future.
Great, super detailed answer. So Jordan, David, I do want to move on to the audience segment, but any final things you want to add on?
No, I think Andrew killed that. That's exactly what people need to understand. And it's the key word that Andrew stated and that you actually mentioned, Daraj, is the realized losses, right? That's the key. So you got to make sure that there's that recognition event where you realize the loss. And if that happens, just like Andrew said, It's not a good situation to be in, but it can be advantageous in future years, right? So, or even advantageous to offset some gain that you had earlier in the year, right? So that's why we do those tax loss harvesting exercises. But I have nothing to add. That was very, very, that was perfect.
Same.
Yeah, I will say.
Thank you guys. I appreciate it.
Awesome answer. Well, now it's the time to answer your questions, and I see there's quite a lot already, which is great to see. So let me go through. I do see a question about exchange bankruptcies. Like, what should you do? About reporting your gains if your exchange went bankrupt afterwards, and you don't necessarily have access to that cryptocurrency anymore. Jordan, you want to start us off on this one?
Yeah. So this is an unfortunate situation. Obviously, a lot of people are in this situation in the U.S. With platforms like Celsius, Voyager, BlockFi, others as well, obviously. But those would be like I'll focus on that part, and then maybe we can talk about other issues if audience brings up more questions. But with those centralized lending platforms, where I think where a lot of these issues are coming in with a lot of questions is, hey, I had my crypto stored on this platform. I was generating yield, interest effectively, and those rewards are taxable to me. But my money is stuck there. I can't get it. What do I do? Well, there's a couple of things. One, we've seen these centralized lending platforms that are now defunct. They have sent out 1099 Bs and MISCs to users. That means the IRS will get one side of those transactions, and they'll expect you to report the other side as well on your tax return. The 1099B issue, which we can talk about for hours, those are most likely incorrect just because of basis allocation issues. But the 1099 MISCs that we see from those centralized exchanges or those centralized platforms, they usually are pretty accurate. They tie out, even if we were going to use, different price oracles from Crypto Compare or just look at CoinGecko or whatever, they're pretty damn accurate. And those numbers are actual income that users that had funds there need to pick up, unfortunately, for tax purposes. Now, the question people have is, that doesn't seem fair. My money is gone. Well, there may be some tax benefits or some tax advantageous, things that you can do down the line once we get some more clarity with what's going on with these bankruptcy proceedings, with those holdings, the underlying holdings. But the yield that you generated, we believe that the IRS will take the position and the accurate position that you were generating these rewards at all times throughout the use of the platform. You had control over the funds, and you could have withdrawn them, and it's income that you have to pay tax on. And that's an unfortunate situation, but that's the reality of the situation with the yield as far as that goes. What happens subsequent to that with those funds? Are you going to get something back? Is it going to be pennies on the dollar? Is there going to be a buyout of one of these platforms where maybe you get more funds than you otherwise thought? That's a whole different story and a different ball game. But people in those situations that have this reward issue where they have to generate or pick up the income, going back to what Andrew and I were mentioning earlier, those people should probably be filing extensions to wait and see what's going to happen with, and you may not get clarity within the next 6.5, 7 months, but wait and see what's going to happen, because you may take a tax position now that may not be a valid position 2, 3, 4, 5 months from now. So on the yield side of things, unfortunate, but there could be some light at the end of the tunnel. We'll see what happens from a tax perspective. Obviously, no one wants to have their funds stuck in an exchange for 7, 8, 10 months, maybe longer. And we've seen that time and time again in the crypto space. So that's what I would say. But if you have one of these unique situations, I do think it's not, yeah, you could do your research, you can go online, you could find answers, but you probably should reach out to a professional just to get an opinion on what your next step should be with what's stuck in those platforms.
Gotcha. Fantastic. Everyone's got some fantastic answers today. This is great to see. So we'll go on to the next question. This one is from Yoga Oasis. They ask, how does the regular income from staking and interest differ? I'm assuming this interest refers to interest from a centralized exchange. Is there a difference as to how these are registered on your tax form? Andrew, you want to take this on?
Sure. So, in general, staking is taxed as income at the fair market value at the time that it's earned. And so, if you're earning rewards or staking and earning over a period of time, you may have several taxable events even in a given day. Some protocols give rewards every 6 minutes, and so every 6 minutes, for instance, you'd have an income event, and the value of that reported on your tax return would be at the fair market value at that actual time. The same thing applies when it comes to using the centralized platforms that Jordan talked about, such as Celsius and Voyager, where you're earning yield or rewards as well. Those are also income to you and reported on your tax return as such. They generally will differ from interest from a bank account, for instance. Bank account interest is typically reported on Schedule B on your tax return, but depending on the type of staking and how it's reported, in many situations, it's reported as other income on line 21. So just a separate place that it's typically reported. But either way, the value of it is determined as soon as it's earned. There has been discussion and debate as to whether or not staking should actually be taxed when it's sold rather than when it's earned. So this is more like things like fishing or farming or the real mining, pulling minerals out of the ground. Those types of things typically taxed when you sell it. But crypto mining, staking, the rule of thumb that most practitioners go by is that it's taxed at fair market value as it's earned. And that's what the IRS has basically said that the treatment should be. There was a case a few months ago to try to change this. Unfortunately, it didn't lead to an outcome that we can cite as precedent. So as of now, unfortunately, the rule is that it's income. So hopefully I hit on that answer, what the individual asked, and then provided a little bit more. So, yeah.
Yeah, fantastic. David, can you tell us a little bit about how a platform like CoinLedger can help people report income?
Yeah. And I think building off that, like the difference is, when you're trading, you can get, it's capital gains. If it's short term, it's going to be the same as if it was normal income. But if you held assets for longer than a year, you'd get beneficial tax treatments and lower tax rates. So that's also where it'll differ from, if you're earning from a staking program, that's going to be taxed, as Andrew alluded to, ordinary income, which depends on my personal tax bracket for the year. But if, I sold it later and I held it for a year, you'll get a little bit more favorable rates because of long-term capital gains. But so CoinLedger works by, integrating with your wallets and exchanges. So you can import all of that and the software will figure out, was this earned as interest and thus it needs to be reported as income, or, were these trades and thus I need to apply capital gains, either long-term or short-term.
Gotcha. Thanks for adding that on. So I am seeing a few questions about missing cost basis. It's a common issue that investors run into, unfortunately, when reporting their crypto taxes because of cryptocurrency's unique properties. David, can you talk a little bit about why someone might encounter this issue and then what they can do, in the situation where they see it?
Yeah, there's many, many reasons why someone could run into missing cost basis issues. It's kind of the crux of the problem of crypto and taxes is it's because the assets are interoperable, right? I can buy from Coinbase, I can transfer to MetaMask, I can bring that into various other protocols. Every transfer, it can be difficult to track, well, that original buy price, which sets your cost basis in the asset. And so the most high level generic reason why you would get missing cost basis warnings within CoinLedger, for example, would be we're missing that original, purchase acquisition. And so if we're missing that original time or that original data on how you acquired it, there's no way we can assign what your basis in the asset is. And so, we'd really have to drill into the specific case of your example, who's ever asking the question, because let's say, you didn't connect up some wallet that you traded Ethereum for some other coin in. Well, if we don't have that trade from ETH to that XYZ coin, you name it, maybe later on we have a disposal of XYZ coin, and then we're going to throw missing basis because at some point we didn't catch that trade. So typically you're missing some amount of data. Our support team can help you try to figure out where that missing data is. But it's a challenging issue that we're constantly trying to improve. But you're not alone. So I'd say work with our support team. They're really good, and they can help you try to figure out where that missing basis is stemming from.
Yeah, thanks for that, David. Tough with the amount of wallets and exchanges that investors often use. So here's a question from Angel. So Angel asks, if I lost my keys for a wallet, can that be reported as casualty loss? What kind of records would I need to prove that? Jordan, you want to take this one on?
Well, yeah, that's it's a bad situation to be in. Obviously, you never want to lose your keys. You never want to have any sort of potential casualty loss that you think might be a casualty loss, because currently there's no way to actually deduct those sort of losses. A casualty loss, we had the ability to deduct casualty losses, but in 2017, in the Tax Cuts and Jobs Act, people may remember there was a big to-do about that. There's something that was passed, and some people hated it, some people loved it. But what happened was the time frame from 2017 to 2025, when there would be something that could be considered like a casualty loss for property, that is no longer allowed unless there's a federally declared disaster, right? So losing your keys in a hurricane, maybe, but misplacing something and I don't know what you would have to look at the specific case of what happened there, but it would be very, very rare to be able to deduct a casualty loss there. We had, there are instances where things like this happen, right? Just recently, where I live in Los Angeles in California, we had a disaster zone declared, right? And they automatically extended every single taxpayer in like 99% of counties in California for an automatic extension where you don't have to file or pay your tax until October 15th deadline. And if something like that happened and that was the cause of maybe some damage or loss, then maybe you have the opportunity to do that. But unfortunately, that is not the case. You can spend a lot of money. Like, I know there's a story of someone that spent a lot of money trying to remove garbage from a junkyard to find his keys and all this information. And then ultimately there was not as much money on that wallet that he thought. But you could do that. You can try to find a way to recover those funds. But at the end of the day, that's not really something that is feasible in the current tax structure. So we hope that never happens. If it does happen, it's a very unfortunate situation, and there may be some potential tax benefits, but for like a casualty loss, that might not be the case. So that's not the right route to choose. And it's something that you want to just make sure you're protecting all of that information. You don't want to get any phishing scams. You don't want to lose access to your funds. And you don't want to get into these situations where you have to figure out, hey, is there something I could do to write this off? Because oftentimes there isn't. But there are some situations where that can be the case. And I would say if you have one of those situations, or if you think you have one of those situations, you can reach out to a professional that can walk you through exactly what you would need to do to maybe document this process or to of what happened, or maybe take a position on a tax return that you can get the benefits of some sort of loss deduction. But the casualty loss is not something that is really feasible in the current moment.
Gotcha. Andrew, anything you want to add on about casualty losses?
No, Jordan got it. Perfect.
Sweet. Let's keep moving. So I do see a couple questions about 1099 forms and why exchanges, often don't provide these forms to give people a complete record of their gains and losses. Andrew, you want to talk a little bit about this?
Yeah, and this comes to one of the points that David had raised earlier, that cryptocurrency, much different than stocks, Typically, people will move it from one exchange to another, one wallet to another, to an exchange, back around again, sell half, move it somewhere else, and around we go. With stocks, that doesn't really happen. It's unusual to be moving it on an ongoing basis. Maybe you move your IBM stock from E-Trade to Robinhood, but that's basically it. You're not moving the stock around in order to take advantage of price changes or to your personal wallet. It just doesn't exist. So with crypto, the exchanges are actually going to be forced. They're going to be required in the coming years to issue tax forms. And so some of them are starting to get a head start and starting to issue these 1099B forms. 1099Bs are the same tax forms that brokerage institutions like Robinhood issue. They identify the cost basis, the sales price, the date acquired, date sold. They show it all. They make it very easy for people to do their taxes. But with crypto, historically, this hasn't existed. Now it's going to be required, but there's this gap. What we're trying to do is make this form fit crypto. But crypto is different because of the reasons that we discussed. And so, for instance, when you transfer Bitcoin from your Gemini account to your Kraken account, maybe to your wallet in between, the cost basis information or the price that you acquired it for originally isn't moving with it. The Bitcoin's moving, but not that data. And so then if it's sold ultimately on a Gemini, but it was acquired on Kraken, Gemini won't know what it was bought for. And so now there's this hole in the form. And that makes it not only difficult to do your tax returns, but it even complicates the process because now we have to try to match what's being issued to the IRS. And separately, we have our own calculations with all of the data being considered. So if you're receiving 1099B forms from exchanges, it's something to certainly be a little bit more careful about how it's being reported, and may make sense to talk to a tax professional about. But it's something that we expect to see more and more of in the future. I can go on and on. I'm sure Jordan and David can as well for hours about 1099B forms and the headaches they will cause, but we'll leave that for another time.
Gotcha. Yeah, there's a lot to talk about in that topic, and I'd recommend if you're interested in learning more, check out our blog about 1099 forms. Definitely a lot of info, but we do have a few minutes left, so we'll try to answer as many questions as we can. Here's one for Jordan. Someone just asked about how transferring crypto from one exchange to another, first of all, is that considered a taxable event? And also, does that affect cost basis at all?
Great question. So this kind of is just an addition on what Andrew was talking about, because the transfer from one exchange to another will create some complexity on a reporting standpoint if those exchanges will be issuing those 1099s because of the basis issue. But just like he was saying, basis will transfer over. The exchanges might not know what your basis was, which causes the issue, which is why you need CoinLedger, right? That's the whole purpose. But it won't trigger a taxable event. It's like you had a bank account at Silicon Valley Bank and you had an inkling that there was going to be a problem, so you transfer your funds to like JP Morgan. It's not like a taxable event. I just take money from my right pocket and put it in my left pocket, right? The issue lies in making sure you have that information in CoinLedger so that it's accurate, that there's a wallet to wallet or exchange to exchange transfer, so there aren't any of these missing transactions. Like David was saying, if CoinLedger can see everything, then there shouldn't be any basis issues unless some weird transaction, weird token, price oracle issues that you need to kind of manually edit, which happens sometimes. But just sending funds from one wallet to another or one exchange to another will not trigger a taxable event. It's simply just like if you had, multiple bank accounts and you just wanted to move money around because you were uncertain about the standing of one bank, or you had cash in your left pocket and your wallet in your right, and you took the cash out of the left pocket and put it in your wallet in your right pocket. It's a very simple thing that you're doing, but I will say it can cause issues in your tax reports, both with what you may receive from these exchanges in the future and within CoinLedger if you don't have all of the pieces of the transaction history. then you're going to look at it, you're going to say, why is it showing as a gain? Why is there missing basis? Well, it's because you didn't import all of your wallets or all of your exchanges where you had those inter-wallet transfers. So even though they're not taxable, they're very important to capture for your crypto tax reconciliation.
Fantastic. Thanks for the answer, Jordan. So we do see you guys have a lot of questions, so we'll go a few minutes over. So here's a good question that we get a lot. It's relating to the DeFi space. You know, a lot of DeFi protocols might have you swap like ETH for staked ETH or something like that. In general, crypto to crypto trades are considered taxable events. How would a transaction like this be taxed? Andrew, want to take this one on?
Yeah, sure. So as you mentioned, the general rule is that any crypto to crypto exchange or trade is a taxable event. It says if you dispose of the first for fair market value and acquired the second. And so here things could potentially be different, but in most cases, we view it as just the same. So the fact pattern here is perhaps you're contributing Ethereum to a staking protocol or a LP pool or something like that, and you're getting another token in return. ST ETH, C ETH, A ETH, whatever you want to call it, AG ETH, make my own, but you get another token in return. The general rule, again, is that you have an exchange. You get a disposition of your original asset and you have a new asset. But it really comes down to the nuances of what that new token is and how it can be used. It's very clear when that token, for instance, has new unique attributes. It can do something that the original one didn't, for instance, staking. But when it is just the same, there are perhaps arguments that it could be a non-taxable transaction. But in most cases, the wide variety of times, we view it as taxable. That it is a trade just like any other. But I would suggest looking into the facts of the exact trade or circumstance that each person has.
Great answer, Jordan. Anything you want to add on to that?
No, I think that's great. I think that you can tell that Andrew and I are both lawyers because we are constantly saying it depends and you have to look into the facts and circumstances of each individual, but it's true. It's true. I don't have anything to add. I think that generally speaking, like Andrew said, any sort of token for token swap will trigger some sort of taxable event, most likely, especially if there are different characterizations and things that the other token can do that the underlying original token couldn't. Certainly, this is a much larger issue now than it has been in the past. And when I say in the past, I mean, because I know Andrew's been doing this since like 2014. I've been doing this since 2017. These issues weren't a thing really. But 2020, 2021, and now recently with a lot of these staked assets and interest-bearing assets, it's a huge question. We get it all the time. Don't just, take a position without getting an understanding of what you're doing. I would say if you're doing your own reconciliation in CoinLedger, at least get an opinion. That's what I would recommend, because you don't want to get into the situation where you file something, it's egregious, it's not something you should be doing, and then down the line you have to call Andrew and say, hey, the IRS just sent me this notice and they're penalizing me this, they're assessing this with back taxes, interest and penalties, and then he's going to have to negotiate for you, try to minimize all this stuff, minimize the tax burden, maybe file an amended return. Tons of things that you don't really want to have to do, which will cost you more money in the long term than it would have if you just did it right or got an opinion up front. So I don't really have much to add other than these they're not really niche transactions, because this is what I think the majority of our on-chain users are doing now. It was something we would say are more obscure in like 2021, but now this is the norm. You probably should have a conversation, have a consultation, get an understanding of what it is that you're doing and how it impacts you from a tax perspective. And then you can say, okay, this is the position that I want to take. This is the position I will continue to take. And as long as you're reporting, acting in good faith, and not disclosing, you should be okay.
Fantastic. So I do want to cover something that's more of a CoinLedger specific question. Somebody asked about editing transactions within the platform. David, can you talk about how a CoinLedger user can go about doing this?
I would be interesting to see the specific question, but generally speaking, yeah, you can click into a transaction and edit things from the value of the asset, the amount of the asset, what wallet you got it from, right within CoinLedger, because sometimes maybe you want to override some of the data that we're automatically piping in, and that can be done right in the platform.
And David, correct me if I'm wrong, but a new feature in CoinLedger, when you add a tax professional, they can now make edits in your transactions for you and help you, as opposed to just kind of figure out what's going on and then kind of tell you what to do, or possibly have to log into the account, which is extremely helpful if you do need tax help, if you do need to add a tax professional to your account after maybe you've reached out to support, you've done your expert review. Maybe you're like, you know what, maybe I need some additional help. There are tools in CoinLedger, not just for the user, but for accounting and tax professionals now, which is incredible and makes the user's life a lot better and easier because it's more efficient. So I think that went live.
Yeah, it's live. It's live. Something we
Wonderful.
have been meaning to do for a while, and finally we got enough blowback, and we're like, all right, we just got to build this. And so that's all live now.
If you
Good
guys
then,
need
yeah.
something, if you need something done, tell the team. If you build, if you ask, they will build it. It's not the other way around. It's not
Right.
the field of dreams. If you ask them, they will build it. So
Exactly.
they'll get it done.
Enough, we will build it.
Well said. Well said. So going through a couple more of these questions. So I do see a couple more questions about cryptocurrency losses. Just in the case where your wallet is hacked, or in the case that you are investing in a project that goes to zero. Let's talk about both of these scenarios. Andrew, you want to take this one on?
Sure. So in the case of hacks, it's very similar to scams, thefts. It's really in the same vein. And so the ideal tax position would have been that we could take a deduction for a theft or casualty loss. And as Jordan talked about, that went away with the Tax Cuts and Jobs Act. So that would have typically been the default. And if you had, for example, bars of gold that someone scammed you or hacked, I guess that hack doesn't apply to bars of gold, so they stole it from you, then you would typically take that deduction, which doesn't exist now. So with crypto, though, sometimes we look to see, are there any other opportunities or ways to take a deduction? And there's a few that potentially apply. If the crypto is being held for business purposes, then there's potential to take a business loss as a result. So that's one area. Another argument potentially is that it's a worthless security. And if it's a worthless security, then it can be treated as a capital loss, and you get a capital loss for the cost basis. The problem with that argument is that the vast majority of time in crypto, we are arguing that crypto is not a security. In fact, we take a lot of the tax rules that benefit crypto that don't apply to securities, such as wash sale rules, and apply those to crypto differently. So to now take it on a capital loss as a worthless security seems to be inconsistent in most situations. So there's a few different things to potentially look at. Another one being a Ponzi loss deduction. There's even the potential to take that if it was lost in a Ponzi scheme, which some of these scams are. And with the failures of some of these platforms, we're even hoping that maybe over the next several months leading up until October 15th, maybe some of these get considered Ponzi schemes. So there's a route for a deduction there. As Jordan mentioned before, I'm an attorney, he's an attorney. Our favorite phrase is "it depends," and depends on the facts. Here, it really is that same thing. And especially if you're thinking about taking a more aggressive position, taking a capital loss, or even more aggressive, an ordinary loss, perhaps related to a business, it makes sense to talk to a professional. Like Jordan said, it may not even be a full engagement, at least have a consultation to talk through your situation. The tax benefits can be significant, right? You're taking a loss for a large hack or theft, it could be significant. You don't want to be in the territory of taking a false position on your tax return later when audited and have substantial penalties or even worse. And not just trying to scare everyone, but it's just the reality of the situation. So before you take a position like that, you should consult a professional, walk through your situation.
Well said. Well said. So, finishing things up here, Jordan will do one last question. So this is one we get a lot, and I think we've talked about it on other live streams. But what should someone do in the in terms of tax reporting when they get an unsolicited airdrop to their wallet? How is that reported, if at all?
Got it. Well, good question. With a massive airdrop announcement today, it's always good to bring up airdrops. So for your, fellow Arbitrum users on this stream, hopefully you were rewarded for your early activity there. But that is something that's different than like a, call it, spam airdrop, right? So when you receive an airdrop, traditionally what we see is that that's income, right? And we know that we have guidance. The original guidance was something that we got when it was an airdrop a hard fork coupled with an airdrop. And from there, we have some subsequent pieces of guidance. But the reality of the situation is when you receive an airdrop, it's income upon receipt most times. Some people want to change their approach with specific airdrop functions and how they actually receive those tokens and all that. But when you receive something like a spam airdrop that's almost like a phishing attempt, or it's like a advertisement, or it's a token that really doesn't have any value because there's either no liquidity pool for it and it's not tradable, or even if it is, it's like you can see there's like $2 of liquidity in the pool and someone's just trying to mess with you, or someone's just messing with the price and something looks like it's worth $47 billion. That is something that you don't have to necessarily pick up on your tax return because there's no real income there. There's no real value. Now, some people take the approach that you can ignore those transactions in the reconciliation. We don't really like to ignore any transactions that we see, but you can technically, theoretically ignore them for tax purposes because there most likely is not any sort of income associated with those spam airdrops. Will it clog up the wallet and will it look funky in CoinLedger when you see these tokens that you have no idea what they are and you never bought them and you're wondering why they're there? Certainly. But from a tax perspective, you won't have any sort of significant issue at all. In fact, you probably have no income from that. But there are airdrops that you will receive that will have an income or a tax related consequence. So you have to be aware of that. But specifically with what I think this question is asking with those spam tokens or the phishing attempts or even spam NFTs that people receive, there's likely no income issue at all there.
Fantastic. Andrew, I do know that you have to get going shortly, but thanks so much for joining us. We really appreciate it.
Thank you very much for having me. It's been a pleasure. David, great to see you. Jordan, as always.
And we should quickly plug Andrew and Jordan. So if you do need advice from a professional, a little bit more help than DIY software like CoinLedger, you should hit both Andrew and Jordan up. They've been both doing it for a long time. And if you just want to do things yourself and work through CoinLedger, it's coinledger.io. Diraj, I don't know if you have anything else before we jump off, but it's been good to do this.
Yeah, I mean, David, I do have one last CoinLedger related question if you want to answer it. So someone asked, is it necessary to provide wallet addresses along with CSV files to CoinLedger? And
wait, say that again. I missed it.
So is it necessary to provide wallet addresses along with CSV files to CoinLedger? Like
you just need to do one or the other. So we just need the data in some fashion. So if we have a direct integration with the blockchain that you're pulling from, Ethereum, Solana, Arbitrum, Optimism, we directly integrate with, just enter your public wallet address and we'll pull all that in automatically. And then you don't need to mess with CSV files. But let's say it's a different blockchain that we don't yet support. Cardano is launching soon, but let's say it's that. Then you can use our kind of universal CSV template to enter those trades manually, right? That'll be a little bit more annoying, but you can still input them through a CSV file. Excited that the Cardano integration will be launching soon, but yeah,
huge.
Don't need to do both, just one or the other, however you're going to get that data in.
And I'll just add really quickly, because I know we have to jump. This is some tax reconciliation alpha. If the integration has all of the transactions, but for some reason you think there might be like a slight issue because the reality is you're interacting with complex smart contracts. You're doing something within a protocol where you can't quite see everything. It's not visible. What you can do, and what we do all the time, is we will import the data with the API, because CoinLedger will scrape it for you. You can see the transactions. You don't have to upload the CSV, but you might want to export the CSV from the Block Explorer and look for those transactions that you know might be causing issues because they're complex. So the software is great. It will read the data, but if there is an issue, it might not be software specific. It could be based on the actual transaction that you executed being a little more complicated. And so that is our tool that we use. We use these block explorers and we do our own little manual analysis so we can focus on, if you put 1,000 transactions and 25 of them need review, it's probably because those 25 are very complicated because you interacted with something, or you did something, or you staked an NFT, or you did something on Arbitrum and like GMX, and it's just pulling weird. So you can use both, but like David said, please only upload one, because if you upload both of them, your report's going to be out of whack, confusing.
Yeah, you'll have duplicate data.
Yeah.
Gotcha. Well, that is all the time we have. Thanks so much for tuning in, and thanks so much for all your questions. If we couldn't get to it, I'm sorry. You can reach out to CoinLedger support as well. We're happy to answer any questions you may have. So before we jump, Jordan, can you tell the audience how they can reach you?
Yeah, of course. You can reach me on Twitter, Taxing Crypto. I'm managing that. Or my law firm's email, which I'm not email, Twitter account, which I don't manage, not as active over there, but Bass Law Firm, at Bass Law Firm. You could reach me via email if you need to. Send me an email, Jordan, JORDAN, @basslaw.io. Or you can connect with me through the CoinLedger platform. And if you need to get a consult, or if you need to get some advice, or if you need someone to look into your account after maybe getting an expert review, because the expert review is fantastic and it might actually solve your problems, by all means, feel free to book some time with me. We'll chat. We'll have a 30-minute discussion, and we'll figure out if this is something that needs to be done, or is it something that we could figure out in those 30 minutes and kind of lead you on your way, similar to what that expert review is. But I would highly advocate for those expert reviews. I've had people come to me and say, hey, the expert review was amazing. They gave me all of this advice. I don't have time to implement it. Can you do it for us? Right. And that happens. And that makes my life a lot easier as well. So yeah, reach out to me however you need. I think, if you have questions, I'll try to answer them as quickly as possible. But the CoinLedger support team will most likely be able to answer any question that's software specific.
Totally.
Right. Exactly. Yeah. And yeah, our expert review service is great. So helpful, especially if you just have a lot of transactions that you want another pair of eyes on. So again, link to sign up for CoinLedger if you're still in need for a crypto tax software platform is in the description. David, any closing thoughts from you?
No, I appreciate you helping putting this on, Duraj. I know we didn't get through every question. Our support team, is live just on our website. We have a little chat widget. So if you do want to follow up with your question through them, they will help you to the best of our ability. If it's something super complex, we probably recommend you reach out to someone like Jordan. But thanks everyone for tuning in, and we'll see you again soon, probably.